Okay, so we are starting. So please focus. What we are going to cover now is currency. I'm just skipping all the other questions which are there in the earlier slide. Maybe that will continue next week, one or two questions more. But let's go to the second topic, which is called the currency futures market. Okay. So this will basically, when you have to take a cover, uh, either you take a forward cover or you go take a futures from the stock exchange. So today we are going to stock exchange also and understand how do we take a cover. Okay. That I'll explain you. But before that, slightly a little bit of let's start with the example straight away. Okay. So better it is you can understand better it through an example rather than first understanding the theory. Okay, fine, and everything you will come to know about the futures. So if you have to cover your foreign exchange exposure, either you're an importer or exporter, you can go to the stock exchange and do it. Okay, it's very interesting. So please listen. Okay, and not all that confusing, which we did because the quotes were in different order. Here, there's no, I mean, such confusion. Okay. So currency risk. Yeah. Yash, can you read it? Yash, can you just come in the front, please? Either aa jao. Because if you speak, your voice gets recorded in my laptop. Otherwise, people can't hear you. Okay. Please come. So we are just starting the futures market. Okay. I'm just skipping all the other questions which are there in the list side and starting with a new one. Okay. Fine. So very simple with the simple lines. Okay. So if the exchange rate fluctuates and you expose it to it, then you can suffer either a loss or a gain, and you don't want that. You want to run your business peacefully without affecting the gains or losses coming from the foreign exchange market, because you can suffer a loss as well as you can make a gain. So you don't want either of it. Suppose, okay, then you go and take futures. But if you want to have the gains but nullify your losses, go to the options market. But again, it looks to be very easy, but it's not that simple game. Okay. Okay, so if you are an importer exporter, you are going to suffer a gain or a loss because of the currency fluctuation. Is that okay? Now, before we going to all this theory, I just put it in front, but I start generally with a, with example. Okay, let's start with an example. Okay, understand each and everything through an example. Okay, normally I just update the example and bring it absolutely near to the month in I'm teaching, but this I taught somewhere in June, July, so it is example covering June, July month. But I'll take you to the forward, I mean the stock exchange where you can see the recent quotes. But nothing has changed since then. Okay, so XYZ is an importer. Please listen to it very carefully. There are about 4 or 5 examples and which will make you absolutely clear. So XYZ is an importer. On 1st of June 2023, XYZ Limited to book its outward remittance for 28 July 2023 worth rupees 1 lakh dollars. So that means he is an importer. Okay, he is going to make a remittance to someone. How much? 1 lakh dollars. When? On 20th of July 2023, and today it is going to be 1st of June 2023. Today is 1st of June, and you have to make some payment to someone. How much? 1 lakh dollar. When? On 20th of July. Is that okay? Simple. Now, instead of going to the bank, you go to the stock exchange. Okay, and then you just see what is happening in the stock exchange. On 1st of June, dollar future is trading at 82.6050. The quotes are always given up to 4 decimal places. LTP is last traded price. So when you open the computer, you saw that dollar was quoting at 82.6050 for expiry on 28th of July. Okay. Now, when you go to the market, uh, then you have to buy dollars. Okay. Since you are an importer, you have to buy dollars, isn't it? Okay. As an importer, you're going to buy dollars. Or as an exporter, you're going to sell dollars in the stock exchange. So here you are buying dollars. Okay. So you opened the window for July. Okay. And you saw the dollar was trading at 82.6050. Now, just to simplify, you go to the stock exchange, you will find 12 monthly contracts. April, May, June, July, August, up to March. If it is September running or October running, you will find October till September next year. Every month, one contract. Okay. And you will choose only that contract which is applicable to you. Now, if I'm supposed to make a payment in November, I'll go only to the November month. I'll disregard all other months. Okay. Now, the stock exchange also gives you weekly contracts also. Okay. So you can choose either a weekly contract, but weekly contracts are only for the first near months, like October, November, there will be weekly contracts. But you can even disregard that and choose only a monthly contract. It is only for making things better for you. So they give weekly contracts. Okay. So now one thing you must remember, if you are going to the stock exchange, you are not going to get dollars. You are either going to lose money or make money. Okay. Everything is cash settled. Okay. Fine. You must remember that, and then we'll understand how it works. Okay. Suppose if you go to the stock exchange, for example, let me just take you to the stock exchange, and I'll take you once again after I explain the example. So this is the online trading account. Okay. So this is an ICICI, this is hooked up to the National Stock Exchange terminal. So here I am saying currency. Okay. I want to go into the currency. You can buy, stocks. You can buy mutual funds. You can buy future and options, stock, commodities, currency. So I'm going to currency. So we have entered into currency. Now you want to place order. The first thing is going to do is that you want to place an order. You want to buy dollars or any currency. Okay, fine. So you will get this window. Okay, this is the trading window. Okay, now you have to go futures. Fine. So we have futures and options both. I am explaining you first futures. Okay. Then you select the pair. Now it says it is available for National Stock Exchange only. Bombay Stock Exchange, it is not traded. So here you choose the contract. So you say USD. Okay. Then you say contract. See, you put USD, INR, first four letters, you will get the contracts at the bottom. So it is USD INR, 27th October, 3rd November, 10th November. So you can just, look at these contracts. Okay. So just choose one contract and then select contracts. You go to there. Okay. So, so you'll have you'll have this window. Okay. Look at this window. It is saying that the current spot rate of the dollar is 83 rupees 9 paisa, 0.0975. So if you want to buy dollars, this is the rate. This is the direct rate. You go to the bank, this rate is applicable. This is the spot rate. Now, if you want to buy dollars, okay, so the dollars, if you want to book a contract, then you have a contract for 27th of October, which is 7 days from now. Okay. Then you have 3rd November. Then you have 10th November, weekly contracts. Then 17th November, then 24th November. So 4 weekly contracts, and 28th November is the monthly contract. Okay, fine. Then December, again some weekly contracts. Then you just go and everything is monthly contract thereafter. September, August, July, June, May, April. Okay, so there, just disregard the weekly contract. Just look that there are 12 monthly contracts are there. Okay, and apart from that, you will have some weekly contracts also. Fine, it's your wish. So you have monthly contracts, and the dollar price is given for all the contracts. Okay, so suppose you have to make a payment in the month of December. Suppose you are an importer, and you have to make a payment for the month of December, then this rate is applicable to you. What is the rate of dollar? 83.30. And what is the rate as of now? 83.0939. So here the dollar is going up. So suppose I have to make a payment, say, somewhere next year. For example, July 24, the rate is 84. So as we can see, the dollar is appreciating over the time. Whatever deals which are happening, say, 1 year down the line, we are finding it is going to 84. So the dollar is appreciating. Okay. So let's go back and suppose if I have to buy the dollar, in the month of December, I have to make a payment in the month of December. Okay. So I'll choose 29 December, which is the monthly contract. Okay. The monthly contract would be just very near to the end of the month, 2 days prior to the close of the month. Okay. Fine. So 29, 30, 31st. So forget 30, 31st. 2 days before it will get closed. Okay. So this is the 29 December monthly contract. Now choose this is the price. So either you can buy or you can sell. If you are an importer, you're going to buy. If you are an exporter, you're going to sell. Isn't it? And the rate is 82.32. So just click this. So you'll have this, that day, this thing. That, last traded price is 82.12 because today is a holiday. Okay. So it was yesterday's closing price. Day opened with 83. Day high was 83.20. Day low was 83.4. And the change was 0.15%. The dollar had come down a bit, okay, over the day. The last traded price is 83.12. Okay. So you have some idea, how the market has moved. But then we just come back to the question and then go back again to understand this more detail. Now let's look here. So when you open the window on 1st of June 2023 and you have to make payment on 20th of July 23. How much? $1 lakh. So you go to the stock exchange, you found that the future is trading at 82.6050, which was the last traded price. Okay, fine. Now this is just an indicated price. Somebody had just traded and he has traded at this price. The expiry is on 28th of July. Now, when you have to make the payment on 20th of July, it is coinciding with your payment day. Fine. Even if it doesn't coincide, doesn't matter. But you have chosen the month in which you are going to make the payment. Okay. But I just kept it so that it becomes very simple. So expiry is on 28th of July. Okay. And the dollar is trading at 82.6050. Okay. Fine. Now, you have $1 lakh and there is a lot size. Okay. Dollar lot size is 1000. That means here things are standardized. If you have to buy, you have to buy in lots of $1,000 or 1,000 pounds or 1,000, euros. Okay. Or 1 lakh yen. Now the lot size of yen is 1 lakh, but all other lot size is 1,000. So since you need $1 lakh, so you're going to divide by 1,000. So that means number of contracts, how much you are going to buy? 100. 100 contract is equivalent to $1 lakh because each contract is for $1,000. Is that okay? Clear? Now, what you are going to do is you are going to buy. If you are an importer, you are going to buy dollars. But if you are an exporter, you are going to sell dollars. आपको चाहिए dollars, you are going to buy it. You are an importer, you have to give it to someone. You are a supplier, so you are going to buy it. Simple. Okay. Now, you bought currency futures 100 contracts at 82.6050. Okay. That means you have placed a market order. Fine. You have chosen the same price at which it was last traded. You could have chosen any other price also. Fine. If you think that the exchange rate is going to come down during the day, you can even lower it. But it will be accepted only when somebody is going to, you are buying, somebody is going to sell, then your orders will get matched. Then only the order will get executed. Otherwise, if you think 82.6050 is the market price and this is the price I am going to get, so you place the order at 82.60 because you are not expecting the dollar to go down further. So it's better that you buy at this. Okay. Fine. You can put a limit price also. But here I have not put a limit price. I am saying that I am buying at a market price. Okay. So you bought and assume that your order got executed at 82.6050. Is that okay? Now, the moment you place the order, before the order is accepted, you have to pay a margin. You have to pay a margin. So, since you are placing the order, so you are buying it, somebody is selling you, and you don't know who is. He can be anywhere in the world. Okay, he is also sitting on the computer and he is accepting your order. It's not the exchange which is accepting the order, some other person who is accepting the order. But the stock exchange says that you have to pay a margin, some kind of a deposit, which is currently around 2.75%. It can change here and little bit here and there. Okay, so that means that comes to about 2,26,009. So $100,000 multiplied by 82.6050 into 2.75% will give you amount of 2,26,906. So this much of money you should deposit immediately. If you deposit this, your order will get executed. Is that okay? This 2,26,906, how we have arrived? $1 lakh multiplied by the price which you have chosen into 2.75%. Is that okay? So you deposit this money. Now look at the spot rate which is there in the on your screen. The spot rate on 1st of June was 82.4175, whereas the future rate was slightly higher, which is 82.6050. This is just because the future price will be always higher than the spot price if the dollar is trading at a, dollar would be normally appreciating in the market if you go in advance. Okay, fine. If you go for the future quote, normally that would be the situation, and it is actually like this in the ICICI window. Okay. Now, let's say, is this clear? Any questions here? अच्छा, अब आगे चलते हैं. Now, day comes 28th of July. So you bought it on 1st of what? June. Now you have to make the payment on 28th of July. So you can wait till 28th July. Suppose you waited. Suppose you think that you waited. Okay. So 28th of July comes. Case 1. What is happening? Assume the dollar versus INR rate on that day, the RBI gave a rate of 84.1050. So RBI published the rate on 28th of July, which the stock exchange will recognize, and that will be your settlement price. So it comes to 84.10. At what price you bought it? You bought it at 82.60. The price has happened, it's gone up. It's a good news for you from the stock exchange point of view because you're making a gain here. Okay. But you are an importer, you will be losing because you have to pay the importer at 84.10, but in the stock exchange you made a gain. Okay. Now, so you will be making a cash profit. 84.10 minus 82. You bought it at 82.6050, but on the day of 28th of July, the price has gone up. Okay. The stock exchange will pick up the price quoted by RBI, and that price will be deciding whether you are making money or you're losing money. So here you are making a money. How much? 1,50,000. So in your account you will get 1,50,000 rupees. You're not going to get dollars. You are going to get a gain of 1,50,000. The margin which you paid will get released. You paid 2,28,000. That money will come to your account, and the person who is in the position will lose 1,50,000, and you are going to get gain. Since you have bought it, you are making money. The person who sold you is making a loss. Okay, fine. So you are making a gain of 1,50,000. Now what happens? On the day of 28th July, the rate is 84.10. So you go to the bank, okay, pay them 84,10,500 for the payment which you have to make to your importer at the rate of 84, but your net outflow is only 82,60,500. Since you will be losing on your actual transaction because you will be making a payment to your importer, okay, at 84.10, you go to the bank and bank will say, okay, here you went to the bank and you order for dollars. They will say the today rate is 84.10. You pay 84 lakhs 10,000 and we will give you $1 lakh, and which you can send it to your Supplier. Is that okay? Bank will send it. So they will charge you 84 lakh 10,000 because the rate has gone up. If you have not taken a hedge, you would have suffered a loss. But since you have taken a hedge and you have got 1,50,000 from the stock exchange, so your net outflow is how much? 82 lakh 60,500. Is that okay? Have you got it? समझ आया फरीदा? Okay, what's your name? नहीं आपका नाम पूछा. हाँ? Okay, ठीक है. I keep forgetting it. Okay, 82 lakh 60,000. Is that okay? This is clear? Now he is hedged and his fixed payment is how much? 82.60. Is this clear? Is this clear? 82.6050. Is this case clear? Is there any doubt? Now let's talk about the case 2. Now here the dollar has actually gone up. Now the dollar goes down. It can go up or go down. The first case you are making money. Okay. Second case you are losing money because now you will be losing how much? 1 lakh rupees. You bought it at 82.60, but actually the price has come to 81.60. Okay, so you have bought it in the forward futures market, but the rate has come to 81.60. So, you have bought it something which is now today selling at only 81.60. You're going to lose money, isn't it? So you bought it from someone at 82.60. Assume that person will go to the market and buy at 81.60 and give you at 82.60, and he's going to make 1 lakh rupees gain and you're going to make a 1 lakh rupees loss. But it is all cash settled, okay? So the dollars are not exchanged, only the difference is exchanged here. So since you have bought it, okay, you have suffered a loss because the dollar has come less. So you said, okay, I'll buy it on 20th of July at 82 rupees 60 paisa. But on that day it was 81.60. You are going to buy at 82 something which is worth only 81, so you are going to lose 1 rupee, 1 lakh. So it is cash settled and only the cash will exchange, no dollars. Now margin will get released. And now on that day, your actual transaction, when you go to the bank and actually you make the payment to the supplier, you will be paying only 81 lakh 60,000. But you add this 1 lakh, the loss which you have suffered in stock exchange because you hedge yourself, your outflow is still 82.60. So whatever happens, whatever the rate you have taken at the beginning, 82.60, that becomes your hedging rate. Whether the dollar goes up or down, you are hedged at 82.6050. Let me just explain. There are certain couple of words. If you are an importer, okay, you are bullish on dollar. You are going to buy dollar. You expect the dollar to go up and make money in the stock exchange. But you are going to lose in your actual transaction and it will get nullified. Okay, the gain in the stock exchange will be a loss in the actual position so that you will remain there. But suppose the dollar, instead of going up, you are bullish, but the dollar has come down, you are going to lose in the stock exchange, but gain in the actual position, but you are not going to get that gain. Your actual outflow will be the rate at which you have fixed your position. You have taken your cover. Is that okay? So let's go back again and explain. I'm just again taking you through. You are an importer. If you are an importer, you need what? Dollars. You are what? Short in dollars. You don't have dollars, you're looking for dollars from somewhere. Okay. So if you are short in dollars, you will take the opposite position in the stock exchange. You will take a long position. But as an exporter, you are long on dollars, but you are going to take a short position. You are going to sell dollars. So this is how we translate in the derivative language. So I'll just explain that. If you are an importer, that means you have to pay dollars after 1 month, after 2 months, after 3 months to someone dollars. So you need dollars. You don't have dollars with you. You are short in dollars. If you are short in dollars, you will take just the opposite position. You will take a long position in the stock. You will buy dollars. Okay. So when you buy dollars, you will make money only if the dollar goes up. If the dollar goes down, you lose money. Okay. So you are bullish on dollar, the dollar is going to go up. You took a long position because you are short on dollar. Okay. So whatever gain you're going to make in the transaction through stock exchange, all that gain, if you are a hedger, that means you have underlying position in the real world, both will get offset. Because if the dollar goes up, you are importer, you will lose the actual transaction. And there will be gain in the stock exchange transaction, both will get nullified. So you are hedged. But if you are just a speculator, then you're going to just make money because you don't have underlying position. If the dollar goes up, all that money becomes your cash flow. Is that okay? Have you got it? If you would have been just a speculator and no position to you, and you would have taken a similar position, you would have been making a gain if the dollar would have gone up, or if the dollar would have gone down, you would have suffered. So you're a speculator, you make money or you lose money. In our case of a hedger, if you're an underlying transaction, you're an importer or exporter, then you hedge yourself. Gain in the stock exchange offsets your loss in the real position, underlying position. Or a loss in the stock market will actually cover your gains in the real position. And you're going to be hedged. Under this backdrop, just listen to me again. Here you are an importer. Are you short in dollars or you are long in dollars? Tell me one. Are you short in dollars or long in dollars? You are short in dollars. You don't have dollars, okay? So you are an importer. On 1st of June 23, XY Limited wishes to book its outward remittance. So that means this guy has to pay someone $1 lakh. When? On 28th of July. So instead of going to the bank, he went to the stock exchange. And he saw there was some contract which was expiring on 28th of July. Fine. Okay. So he said, okay, let me just book a contract. So he, when he saw the price was 82.6050. When you look at the spot price, the price was at the last listing 82.41. So he found the dollar was appreciating in a month's time. So he said, okay, let me just buy the dollar because dollar may go up again. So let me just cover myself, okay, at this point. So he bought the dollar at 82.6050. Okay. This was the last trading price. He could have changed the price if he wanted. He was thinking that, and he could have done it for only for that day. If he thought the price would come down, he would have placed the bet at a little lower price. He would have gained further if the price would have gone. But he chose the last traded price, okay, and placed the order. And I'll tell you how to do that. Okay. Once first listen that, then we'll go to the stock exchange and just try to find out which price to choose. Okay. We'll understand that. So 82.6050 he chose. Okay. Now, since there's a lot size in dollars, which is in terms of 1,000 lots, so he is going to enter into a contract to buy dollars. How many contracts? 100 contracts. So he has placed the order with someone for 100 contracts. So that means he says to someone that I'm going to buy dollars, 100 contracts, okay, at 82.60. When? On or before 28th of July. On or before. But anyway, let's say 28th July. He is not talking about before because his date is coinciding with the actual payment date. So he'll stick with the on date. So he says on 20th July, he is going to buy this dollar at 82.6050. Okay. So the moment he places the order, he has to deposit a margin money. Okay. A margin money of how much? 2.75%, which is 2,26,906, because the stock exchange feels that you may lose or gain every day, so that you don't run away. Okay. So to make sure that the settlement takes place without any default, there is no counterparty risk here. So they say first deposit 2,26,000 before you go further. The moment he deposits, his contract is locked. That he is going to now buy dollars at 82.60. Now what happens is, either he can exit the contract before or after, but he waits till 28th of July. The example is like this. So we'll wait. On the date when there is an expiry day, the stock exchange will close your transaction based on the RBI rate. जो RBI का rate है, उस पे आपका transaction automatically close हो जाएगा. Because since you have not closed your position before, so automatically your transaction get closed on the RBI spot rate when they publish that. So the RBI published the rate as 84.1050. You are making a money, so you are happier. So you never closed it before, so you are making a gain. So you got a gain of $1 lakh. So you're bullish on dollar, dollar will go up, and that's what you wanted in the stock exchange because you have an underlying position where you would have lost the money because of dollar appreciation, but you know that here I'm going to make a gain, here I'm going to lose the money because of the actual position, but I'll remain firm at the rate at which I fixed the dollar. So since he has fixed the dollar at 82.6050, he is hedging himself at 82.6050. So he is going to get 1,50,000 from the stock exchange. So whatever the margin he has paid will get released. Now one more thing, that because there is a big gap between 1st of June till 20th of July. So what the stock exchange does, they do daily mark to market settlement. Daily settlement is happening. You know, daily there is a settlement which is taking place. If on the next day, if you are making money, your money will come to your account. On the next day, if you are losing money, the money will be taken off from your account. And if there is a shortfall, you have to deposit. If there is a gain, it will come to your. Every day, the transaction is called mark to market. Every day, the gains or losses will be coming into your account. Losses will be taken from your bank account. So that on the last working day, there is hardly anything to be taken from you or given to you, so that there is no kind of a, chance of any. So there is no count. I mean, there is a 100% protection for this trade. Okay. So here on that day, because since the dollar had gone up, you will be making your payment to the importer at 84.1050, which is 84 lakh 10,000. Okay. But you will be getting, 1,50,000 rupees from the stock exchange, which means your outflow will be only to 82 lakh 60,000. So you are hedged at 82.60. So here in the first case, the rate has gone up. In the second case, the rate has gone down. You have suffered in the stock exchange, but you gained in your actual underlying transaction. But that gain was, not coming to you because you suffered a loss. So your outflows and you're hedged at 82.60. Is that clear? Any questions? Have you all understood? Okay. Now, let's say exporter. Suppose you are an exporter. Here, are you a long on dollars or you are short in dollars? Long in dollars because you are going to get dollars anyway. Fine. You have placed the order. Okay. Somebody has placed the order on you and you are going to get dollars from him. You are long. So you are going to take a short position. Okay. You are going to take a short position. That means you are bearish in dollar. Okay. You are going to take a short position. Fine. So on 2nd of June, he is going to, get his, remittance of 1 lakh rupees on 20th of July. Assuming the same kind of question, now he is going to get $1 lakh. In earlier, he was going to pay the dollar, he is going to get dollars. So dollar future is currently trading at 82.5975. Expiry is on 20th of July. Fine. So he finds the dollar is currently trading at 82.59. The spot rate is given at the bottom. Okay. And then he goes and takes a contract, 100 contracts again. Now he is going to sell currency futures. In case of an importer, you bought currency futures. Now you're going to sell currency futures. And you're going to, how many contracts? 100 contracts. So you enter into a contract to sell dollars at 82.59. Since you're going to get dollars, you have already sold to him a month before. Okay. At what rate? 82.59. But to some other guy in the stock exchange. Okay. Fine. So you have sold it at 82.59. You pay a margin. Okay. And then first case, if the dollars goes down, since you have sold it at 82 point something and the price has come to 80.59, you are making a gain. Here, if the price comes down, you make a gain. In case of a buy transaction, you make a profit if the price goes up. Here, you bought it at you sold it at 82.59. आपने कोई चीज 82.59 की बेच दी. But on the expiry date was worth only 81.59. You are making a 1 lakh rupees of gain. Isn't it? Okay. So the margin will get released, and as an exporter, you will get only 81 lakh 59,000 because the RBI rate is 81. Okay. Add to it because there is a loss on the export transaction, but there is a gain on the stock exchange transaction. Okay. So which means you are getting your money at 82.59. Is it okay? Can you follow? Yes, try over here. I understand. You're talking to each other. see, what has happened, you have deposited this money at the start of the trade. Now, since the trade has concluded, this was just a deposit. This will get back to the bank. Give it as a protection to the bank, but over and above this protection, there is a daily mark-to-market settlement. This is double protection. ये पैसा तो स्टॉक एक्सचेंज लेकर रखी है, उसके अलावा रोज के रोज जो लॉस हो रहा है, गेन हो रहा है, वो भी ले रहे हैं. So that at the end, even if there's a big loss, this money is going to be there with them till the last day of it. So they release this money on the last. Is that okay? So let's just go to the stock exchange and see this whole thing happening there. Now, assuming that you have to make the payment on 29th of December, what is the rate there? 83.2500. Suppose, just think that you are an importer, okay, and you have to buy dollars. What rate? 83.2500. Okay, so you are going to say buy. If you are an importer, you are going to buy. If you are an exporter, you are going to sell. So you are going to buy. Press the button buy. Okay, fine. Now, just before that, okay, just let me explain that. Okay, is that okay? Now you have bought. What is the rate? 83.25. Now you're going to check, you just check this rate. So this is very important. Please, this is going to help. Otherwise, you're going to lose marks here because there's a question here in the quiz. Okay, go to bids and offers. Just look at this screen. This is a very, very important screen. When you're placing the order, you must visit this screen. What is this screen? This is saying, you know, there are a lot of people who are placing orders for buying and selling at any particular time. So you have a feel there. How many people have bought? How many people have sold? The top 5 orders will be displayed to you. Top 5 buy orders and top 5 sell orders. Unexecuted orders. It has not been executed. Somebody has just put them, they have not still been executed. Okay. First of all, these are all, you know, somebody has placed an order for buying $1, one contract. At how much? 83.24. One order. Okay. At price of 83.252425. There is another guy who has placed order for 25 say US dollar, 25 contract at 83.2375. This price is going high, isn't it? Then it is this like this, so it is goes for 83.150. So all these contracts will be stacked in the order, which first one is the price at which you are buying at the cheapest. So this will be at the top. Okay. So these are the buy orders, these are sell orders which have been put simultaneously. Somebody has, you know, sold dollars at 83.3150. Okay. And then somebody has sold selling the dollars, $500 at 83.3500. Okay, these are unmatched dollars. Huh? Number of orders. Huh? Number of orders is basically these are one order, okay, 25, think it's a contract, okay. Just first listen and then you can ask a question, okay. Now, this order is at 83.3150, okay. This order is at how much? 83.24, they are not getting matched. He's trying to buy at 83.24, the top guy is going to sell the order at 83.3, they are not matched, okay. That's why they are still lying unmatched. Suppose he cancels his order and says I want to sell it at 83.2425, then both orders will get matched. Right? So they are all put in the fashion so that they are not matching at the moment. Okay? At the moment, these are orders which are on the hand, they are not coinciding. Because the person who wants to buy, the highest price is 83.2425. This is the highest price somebody wants to buy. The next guy wants to buy at 83.23, he's quoting less, so it's coming in the thing. Second, somebody who wants to, you know, buy at 83.15, one contract, he's given the lowest price. So from the highest to the lowest price, you get that order. So this will get matched with these ones. Okay. So if this guy has placed the order, okay, 83.31, okay, 10. So he has placed the order at 83.31. Okay. So this is not matching. Okay. Fine. If both orders are matching, then they will get matched and they will go away from the screen because the orders will match and they will get executed. अभी ये unexecuted orders है because they are being, somebody is buying, somebody is selling, and they are putting some prices, limit prices. They are not getting matched. So suppose, for example, I am import. I need 100 contracts. Okay. So I am going to place an order. So my order will sit there, depending on what price I am putting. Suppose first I look at this area. Somebody is, so this is your best bid. There are 93 we have number of orders. These are two different orders. Somebody wants to sell his dollar at 83.31. Okay. Suppose I want to buy, say, $93. So if I put this price 83.31, then immediately it can execute. These two orders, against these two orders, my buy order will get executed. Suppose I go and see that somebody is willing to sell at 83.31 and I think it's the right price. I am going to punch the order for 93 buy orders or 90, whatever I need. So I am going to buy 93 and put this price. So my order will get matched against this price and it will get executed. Just to repeat again, I saw this truck. Now I want to place the order for buying $90. I saw that the lowest price at which I can buy the dollar today, as per somebody has put the order, is 83.31. I find this okay. And I fear the dollar will go up from here. So I will punch the order and put this buy order, price order. So my order will get matched and I get immediately executed. Then I have to put these two prices, 83. 93 at this price and 7 at this price. So that means this order will go up and from this 7 order will go up and my order will get executed. Is that okay? Have you got it? Is it clear? Is it clear to you? Suppose you have got 200 or $200. Then we have what price is going to place the order so that we order is matched. Just think, everyone. Suppose you want to buy, I just revise the number, you want to buy $500. What order you should place the order so that you can get it. And whosoever does it, just show your account. Now I'm just putting a question. I want to buy $500. Okay, just hold on. This side, buy $500. This side, all, sell $500. Tell me what should be the price. अगर मैं 500 को ऑर्डर किया 83 पे इसके साथ मैच हो जाएगा बट आई कैन बाय दिस चीप व्हाट इज नेम माधव क्या नंबर गया you just answer without even thinking now that's why I said it's not to come that easy game just on your copy pencil just write you are going to place like order like this again and for your thing 93 30 500 minus 93 500 minus 30 the balance will be this so you are going to place 3 orders okay is that okay आपको 3 ऑर्डर मिलेंगे और आपने बाई करना है place the order for 93 30 and the balance of 500 here which will get executed here so 500 minus this is the balance so you are going to put 3 prices I'm just saying theoretically, things can change automatically in a second. The best 5 buy sell orders can immediately get like somebody has placed the order and we lost it, isn't it?
So these prices are on this particular broker or what they?
Not the broker. It is like you and me were just gone and put their orders. I have a choice to put a limit order. Suppose I want to buy Reliance. Today the price is 2,300. Okay, I can place the order at 2,200. I get it only if somebody is willing to sell it 2,200. Somebody has sold it 2,000, my order will get executed. Or I can place a market order without caring for everything, buy it at whatever price, then you buy the price at which somebody is selling to me. It will get matched with any of the best one. It will get matched with this one, if this is still unexecuted. Got it? If I place a market order, a blind order, my order will first get matched with this. Balance in this and balance in this. Okay. अगर मेरा order बड़ा है, I want to place an order for 1,000, it will go in this order. I'll get this price. If I place a market order. If I place a limit order, then it will be executed only
at the price which is matching here. Okay. If I say I am going to buy at 83.31, only my order worth 93 will get matched. Rest of the order will get unexecuted. Fine. Then it will wait till 5 o'clock in the evening, the market closes, somebody takes the price, then only it gets matched. Is that okay? Have you got it?
Any questions here? Now, this is a very important screen, because about 5 or 10 years back, I suffered a big loss. There is something called impact loss, which is, whenever you read a book, they say impact loss. When you read what is impact loss, you will not understand what it is, unless you actually experience it here. It was like this. I placed an order. There's a bond which I bought for $100 and which was selling at 120 rupees. The last traded price was 120 rupees. So I was making a 20 rupee gain. I was absolutely new to the market, so I placed a market order. Because the bonds are not sold very quite often, it's not a very deep market. So there was the last someone who bought it, somebody who bought it was he got 120. But there were no orders, there were no best buy bidders or orders. So somebody saw that as there is a market order. Okay. So he put a price of 90 rupees and I got 90 rupees. 100 rupees bond was sold at 90, though I wanted 120, but because the last transaction happened at 120, I got that as a market price. Some people are sitting, you take the fun of it and make you lose money. So he saw that somebody placed the order at a market. So there was nobody in the market. So he just saw the rate and he put in the 90 rupees, it got matched. So my 100 bucks was sold at 90. So I lost 10 rupees instead of making a 20 rupees gain on that day. And that gain was what the impact loss. When the markets are not deep, then there is a chance of impact loss. Okay. But generally the markets are very deep. Okay, so there will be a lot of people who will be sitting to buy and sell, and there will be very small this thing. So you may not incur a very big impact loss. Okay, if you place a market order. What's the time? ठीक है, तो अब एक छोटा सा just a small thing, okay, and then 5 minutes, and then we take the attendance, okay. Okay, so let's talk about the speculator now. Please focus here. Please focus. Okay, everyone, this is the last question, okay, and a very interesting question, okay, so don't miss it. So X is a speculator. He is bullish on dollar. So he's not an importer nor an exporter. He is just bullish on dollar. On 2nd June 2023, he speculates for 28 July contract, $1 lakh. Same thing, 28 July is the contract period. So he's actually speculating on $1 lakh. So currently the dollar future is trading at 82.60. Okay. So he'll go for 100 contracts. Since he's a bullish, he's going to take a long position. Long position, he's going to buy at 82.60. There. Please listen, I'm going to ask you a question, give you a 5 marks, minus marks straight away. Okay, just listen. So he takes a long position in the currency. Why he takes a long position? There, gentlemen. जिसको बहुत ज़्यादा सर्दी लग रही है. You're feeling a lot of cold or what? Okay, tell me why he is placing a long order. Anybody? Why is taking a long order? He is bullish. He is bullish and he thinks that the dollar is going to go up and he is going to make a gain out because he is just a speculator, okay? So he deposits 2.75% margin. I have not shown you the margin in the stock exchange, I'll show you, it comes automatically there. Maybe next time. So we'll just cover this only. Now, booking before expiry. Now, he has placed the order, isn't it? When? On 2nd of June. And it is going to expire when? On 20th of July. Now, the first choice was he could have waited till 20th of July. But he can always place his, an order or he can exit from his position before 20th of July. Let's see how. On 25th of June, when he placed the order? On 2nd of June. On 25th of June, the July future contract is trading at 82.90. So on 25th of June, he again entered the screen and he saw the same contract, which was earlier selling at 82.60. Today, it is selling at 82 point because the price can change every day, every second. So he's sitting on what? He's sitting on a gain. He has bought it at how much? 82.60. And today it is selling at 82.90. So he's actually making a gain because the dollar has moved up in the futures market. So what he'll do, he'll square up his position. So how is going to make money? It is called squaring up the position. Whatever order he has placed earlier, he will just place the opposite order on that day. First he bought it, now he's going to sell it. When he bought it, the buyer was he, seller was somebody else. Now when he's selling, he's the seller, buyer, somebody else. So it is not matching with the same person, okay? So he's just booking. So by doing so, the exchange will say that you have already closed the order. एक के साथ आपने ओपन कर लिया, एक साथ क्लोज कर दिया, आपका ऑर्डर खत्म हो गया. Squaring up means taking opposite position in the same contract month, and you can do it on the same contract month. अगर आपने जुलाई में कॉन्ट्रैक्ट का ऑर्डर प्लेस करा था, जुलाई का कॉन्ट्रैक्ट का आपको ऑपोजिट खेलना पड़ेगा. अब now he sells 100 lots at 82.90. Now he doesn't have to pay any margin money. Since he has paid the margin money at the first leg, second leg में कोई margin नहीं है, because it is nullify the first contract. So he will be making a cash profit of how much? 30,000. 1 lakh. 82 minus 82.9 minus 82.6. So he's sitting on a 30,000 rupees profit. He is going to book the profit and walk out of the market. Okay. So margin, he will get back his margin which he paid in the first leg plus 30,000 rupees profit. Okay. Okay. So that's it. So he is going to make a gain. So this is when he is bullish, he can place the order. So let's understand before I close. If you are a speculator, okay, and if you are bullish, take a long position. If the dollar goes up during before the expiry, you can close it. Take the reverse position what you have taken originally. If you have bought it, take the sell it. Okay, now sell. Same very contract, the same month you sell. There will be two, one order for buying, one order for selling, and stock exchange will realize that you have placed two opposing orders, but with different people, no matter, the order will get blocked and you will get your money. If you have bought it at a certain price and if you have sold at a certain price and the price is higher, you make a gain. But if you have bought at a certain price but sold at a lower price, you will make loss and you will be suffering loss. So you can take a long position and square it up. It's called squaring up. Remember the word squaring up for the Buddhist point of view. How you can close your position? You can close the position by taking an opposite position or by squaring up your position. Okay, in the same very month, in which you book the buy order, you have to make the sell the order. You can't go in the month of August and sell the order. It will not get squared up against the July order. Okay, but in case if you are bearish, you think the dollar is going to go down, sell it. First sell it and then buy it. You sell it, if the dollar goes down, you make money. And then you square, you buy it. So buying and selling will get cancelled. You first sold and then you bought, both orders will get cancelled. And you are sitting on a gain. It's called short selling. Without having anything, you are selling something. In that you can do in the stock exchange only, nowhere else. Okay? You can't sell something you don't possess, but in stock exchange you can do it. You can sell it and then buy it. If the price goes down, you make money. But if the price goes up, you lose money. Okay? If you are bearish, then you short sell. If you are bullish, you take a long position and buy. That's it. Attendance. Duven Ajo. Huh? Just let me just open the attendance window and then you can come in and ask me the question. Acha, ask the question first.
Sir, if you are bullish and say the price increases, only then will you square up, right?
Yeah.
You will not square up with the price.
You will square up also. There is a chance that you have to square up because suppose if the price is going down and you expect to go down till the expiry, you just cut your losses. Cut your losses. That's called a short covering. आपको शॉर्ट कवरिंग आपने पीछे गिर रही है और आपका नुकसान कम से कम हो, you cut your losses.
Exit before the expiry happens because then you're going to lose a lot of money. हाँ ठीक है, इनको आप नाम बता दो ये. Shivnara. Oh, let me just close this.